Rand has touched a fresh 11-week low against the dollar, partly pressured by investors' fears that a credit downgrade could be in the offing for South Africa from Fitch later today. Now, the sovereign credit rating indicates the risk level of the investing environment of a country. It's used by investors looking to invest in that particular country. Fitch Ratings lowered the outlook on the nation's debt to negative last year, signaling a possible credit downgrade. So it's all eyes on today's review. A cut would put the rating in line with Standard & Poor's at one level above junk. Moody's, another ratings agency, also on the second lowest investment grade level, said last month that its credit rating for South Africa took into account the country's power shortages, the growth challenges, and would probably remain unchanged for the next 12 to 18 months. Well, Fatima Bhoola from the Economics Department at Fitch University joins me now to chat about what we are likely to expect later from Fitch. Fatima, thanks indeed for coming in.
Good afternoon, Devin.
Okay, before we take a look specifically at the Fitch review this afternoon or later this evening, let's just talk about what becomes the focal point when it comes to countries, when ratings agencies look at us. Very often, it's our budgets and it's our deficits.
Yes, those are critical factors that they take into account, but they also look at other factors like possible event risk, in our case, country-specific risks like the Eskom uncertainty around Eskom's ability to supply power, but in most instances it's the budget deficit, the current account deficit, which if widening is a problem, and I think particularly now it's our growth forecasts, which are low at 2%, and for the first quarter came in at 1.3%, much lower than the forecast.
It's a frightening scenario and interesting. We had the Reserve Bank Governor, Lesetja Kganyago, yesterday, or in the week, saying that Treasury has things in order. We've got our budget deficit in order. We've got our current account deficit pretty much in line. Was that convincing?
Not quite. While he did allay fears that the credit outlook is a lot better than what it was last year, and that they are able to finance that current account deficit comfortably. The way they're doing it may not be sustainable, using short-term debt instruments to try and take care of long-term debt.
Yeah. When we look at what Fitch had put forward, I think it was December when we were last graded, we're pretty much in that negative outlook for quite some time now with Fitch. I want to point out to our budget deficit here and talk about our wage deals with the public sector. At 7%, I read an article in the Financial Mail which gave us a bit of a shocking review, saying that our fiscal circumstances could be in shock and we might use up all our reserves, our contingency reserves, if that wage deal goes ahead and we use up accordingly, according to that 7% increase. Is that a scenario that's worrying?
Yeah, certainly is, because again, it comes above those wage increases, above what was budgeted for, and this is on the back of an already large public sector wage bill, and these may become worrying, where we are having to finance just to pay the wage bill and not really sustainable social spending.
What happens with the other variables now that Fitch may consider? Let's take a look at potential strikes and let's look at the Eskom scenario. Are those big enough as well?
Again, collectively, all of these criteria play a role. Yep. So while our economic downturn in terms of the growth, the deficits playing a major role, all of these also do play quite a significant role in determining their decision later on today.
All right, what do you think will come out of it later this evening? Are we likely to see something unmoved?
Well, analysts are mixed. A lot of them believe that they may just reaffirm their existing grading, which is just 2 notches above junk level, but on a negative outlook. Others believe that in the 6 months, government may have not done enough in terms of fiscal consolidation to convince the rating agency that they're doing enough to sort of curb the unemployment, bring down that budget deficit, or rather making that gap smaller. And all of this might then impact on a possible downgrade.
All right, a lot to look forward to. Fatima Bhoola from Fitch University, thanks indeed for chatting to us.
Thank you.